Yeah, I think there were really three issues that drove investors' perception on Apple and what bid the stock up. One was obviously the performance in China. That had been a drag. China's 20% of the company's sales. So the slowdown that we saw in 2018, you saw a reversal of that. That helped move the stock higher. The second is obviously the massive amount of cash they're returning to shareholders through a big dividend increase in buying back stock. And again, the commitment to the services side of the business, which is going to be higher margin than the hardware sales. And I think those three components is what's helping the stock drive go higher today.
So the buyback factor, last I checked, I think they spent about $24 billion in their fiscal Q2 to buy back shares. That's, if I'm not mistaken, about 5 times what they spend on R&D. I mean, if you take a short-term view and you're an investor, hey, it's great they're buying back their own shares and it's good for what I own. But you take a long-term view and you got to ask yourself, don't they have better stuff to do with the money?
Well, I think you've laid out the conundrum really nicely. You can't ding Apple for having all this cash on the balance sheet and not putting it back to work and returning it to shareholders. But on the other side of the coin, you really see innovation has really left the company post Steve Jobs. I mean, they have not had a blockbuster product really since iPad. The watch has come along, but it has taken significantly longer than investors and I think the company had originally expected. You have not seen any new add-on products in quite some time. So to your point, could they have used some of that cash to dump back into R&D and focus on future product growth? There's something to be said for that.
Yeah, they could have, and they maybe should have. Let's pull it broader very quickly, John. In terms of sectors, you like energy, you like financials. Let's get that out of the way. You can talk more about that if you could. But you think that broadly we're in this situation or environment where kind of by default there's really no other place to be except equities.
Yeah, I mean, when you look at stocks, bonds, and cash, and you say, where am I going to invest my incremental dollar? You can't really make a case that bonds are overly attractive for the exception of offering diversification and downside protection for the unknown event, right? I mean, bond yields on the US 30 year is 2.9%. You just can't get much for your money these days in the fixed income market. Cash is higher than it has been historically over the past 10 years. But that's a short-term solution because it's not a long-term investment option because inflation will eat your purchasing power away. So that leaves you to go nowhere but stocks. And valuations are not stretched. Earnings are doing okay. And the Fed has stepped to the side and said, we're not going to raise interest rates much higher, or we're not going to raise interest rates at all. So with inflation being benign, with interest rates being low, with valuations being okay, stocks look like a good place to be relative to any other place.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.